Martin North, John Adams, in the interest of people. Hello, John.
Hello, sir.
Good to see you again.
Yes, you too.
The number keeps going up.
Yes, today is an important show, Martin, because we have to update our viewers about what is happening in the repo market. We had about 3 weeks ago, we made an important declaration that Armageddon had started when the repo market blew up on the 17th of September 2019. And at that point, 3 weeks ago, we had said that roughly about 530 billion had been thrown at this market to stabilize it. Otherwise, interest rates in the money markets would have been too high, and you would have started to see a series of defaults among banks and hedge funds. So today, what we're going to do with the audience is actually give an update, because since that time, we said that the system was on life support, and they would have to throw ever increasing amounts of money at this market. And that is what's happened in the last 3 weeks. Now, as of last Friday, it got up to about $616 billion Friday US time. So last week was the first time it actually went above 600 billion. Now, with the issues of the oil market blowing up over the weekend, and with a significant stock market crash in the last 24 to 48 hours. So today's Tuesday. So when I looked at the numbers this morning, which was reflective of Monday US time, the number had jumped even higher, from 616 billion to now $641 billion. So we've had a rapid increase of maybe 100 billion in about 3 weeks, and we also saw an important announcement from the New York Fed in the last 24 hours, saying that when it comes to these overnight loans, these overnight repos, and these term repos, the amounts will be increased because of the significant stock market crash. And there's obviously significant concern about providing the market with enough liquidity. And we'll get into some of these details going forward. But it's above 600. And I think even maybe within the next week, we may even breach $700 billion.
Just if we recap on our last episode, what we said there was the Fed keeps putting more money in. They keep thinking it's a short-term fix. That short-term fix keeps getting extended. The amount they put in keeps going up and up and up, and it's going up even more.
Yes. I mean, they initially said a couple of short-term factors, short-term plumbing, and then they kept on saying that this repo crisis, it would end at a particular date, and they kept on saying, from October to November to December. Then in January they said it will have to go out to April, and now we've even seen some more disruption in the market, and now they're saying, well, we'll probably have to go for longer, and we have to even do more, and basically they can't stop. Because if they did stop, interest rate would shoot sky high, and you would start to see a series of defaults.
Yeah, and the coronavirus, which of course is a medical issue predominantly, is now creating a financial crisis. And what it's really doing is peeling back all of the coverings from what was always there. We always said there were significant issues in the financial system, right? The repos was a signal of that, but now basically it's all laid bare again.
Yes. So what I think the share market, and so obviously you've got the coronavirus, but then you've got this disagreement between Russia and Saudi Arabia over the weekend about the price of oil, and that led to one of the biggest crashes in the oil market in the last 48 hours. But what I think the coronavirus has done, Martin, is, so particularly in the case of China, we have seen a dramatic fall in production. The fall in production means that companies are generating less income. With less income, that they have a less ability to service their debts, and that's obviously going to cause concerns in the financial markets, and that has the capacity to trigger a systemic crisis around this big debt bubble. We are now going into the abyss. Like we said in the last show, we can't get out of it, and one of the most staggering things that I find is still, after 6, 7, 8 months of this, no real mention in the mainstream media. Parliament was, we had Senate estimates last week in federal Parliament. No real examination of the Reserve Bank of Australia on this. I'm not sure if our politicians really know what's going on in the plumbing of the financial system.
Well, it is fundamentally very important. And yet I'm betting you that people will blame the coronavirus for everything that's happening, right? It's a convenient explanation. Some would say plausible deniability.
Yes. So we had so someone actually on Twitter in the last 24 hours posted one of our shows from last year where I recounted a conversation in December of 2008 when a federal Liberal MP told me that that certain people within the establishment knows that this bubble is going to come to a point of crisis, and that they were going to find a plausible excuse that they can deny responsibility and basically try to get away with blowing up this huge bubble. So obviously I always thought that it was going to be some sort of international credit event, and like a Deutsche Bank declaring bankruptcy, and they say, well, we don't control Deutsche Bank, we don't control Germany, but it just so happens that a pandemic has come in the nick of time for the global elites and our elites who have basically blown up the biggest debt bubble in Australian history.
And ScoMo today in his speech essentially positioned it just like that the economy was on the turn, everything was looking really, really good, and then blow me, suddenly coronavirus hits.
Yep.
And it's like, come on, does you really believe that is the way that it is? So, and yet that's the way it's being positioned. And of course, it's being positioned like that in other places too.
Absolutely. So Martin, where I think we should just take the audience is, so let's actually go through the numbers in terms of the repo market. And these are from the New York, so the Federal Bank of New York for the 9th of March. So let's put this on the screen. So we have a series of ways they are bailing out this market. So we have these overnight repos, which are overnight loans to banks. So in the last 24 hours, that hit 110 billion. We have what is called these term repos, which have 14-day loans to banks from the New York Fed. So that's about 90 at this stage. And these permanent open market operations, which is these permanent purchases of T-bills, short-term bonds, is up to now 441 billion. So the total is 641.94 billion. And just like we said before, there is there has been a statement by officials saying that with these overnight loans and these term loans, so they try to give some guidance as to how much they're willing to give. They said that they are increasing those thresholds, and we could easily be up to 700 billion by the end of the week.
So, John, it's worth, I think, just going through what happened in a bit more detail, because there are some complicated movements on and off balance sheet, right, and different types of transactions. But it's actually quite interesting to understand what's happened.
Yes. So we're going to put a graph up on the screen. So one of the things I've been doing privately is just downloading all of the data, all of the official data about these overnight repos, term repos, and these permanent purchases. And so I've put it on a graph. And as we can see on the graph, so I started this graph from about the 12th of December, noting that this all started back in sort of It didn't start actually, some of these operations didn't actually start on the 17th of September, because by late July, they already had noticed there were stresses in the repo market. So they were doing it very gently, some of these injections, and then it started to really ramp up after the 17th of September. But basically what we can see, Martin, is that roughly around the 12th of December, we were just over $400 billion in terms of this quantum of money being supplied to the repo market. And again, we don't know where the money has gone, because the officials have said that they don't have to respond to freedom of information requests, which certain requests have been made. So they said, we'll tell you in about 2 years' time when this is all done and dusted. But basically what we've seen over the last few months is we've gone from about 400 billion. We hit $500 billion on the 3rd of January. And then basically 2 months later, 3rd of March, which was last week, we breached the 600 billion mark, and we hit about 616 billion there. And then obviously now with this with the stock market crash and the crash in the oil market, we've seen an even greater extent of liquidity being provided to the banks and the hedge funds, and now we're up to this 641 billion. And no doubt we'll be seeing even greater amounts being injected tonight, and we'll look at those numbers in due course.
Right, and some of those were actually oversubscribed, weren't they?
Yes. So one of the important things about last week's action was that so we were around the 540 billion mark, and then we quickly went up above 600 billion. And so last week was about these so-called concerns around the coronavirus, and the issue. What happened there was a dramatic increase in liquidity provided, and that's why we went above 600 billion. But what actually happened on 3 days was that when they actually, when they went to the market and said, how much do you want? So the New York Fed had a certain limit in which they were willing to provide to the market. And on 3 days, the amount that the market was asking was about, in total, 123 billion more than what was actually provided. So this is what they mean oversubscribed. So there was this issue of, like, okay, we want to buy your bonds, we'll provide cash, and basically you put in your bids, and the bids was in 3 days, adding them all up, cumulative 123 billion. Now, why is that significant, Martin? Is because it says to me that the issues in the banks and the hedge funds is bigger than what officials are willing to let on. And so when you have a succession of days where people are asking for 20, 30, 40, 50 billion more than what they are willing to provide, it says to me that the problems in the banks are bigger than what the market actually anticipates. And again, it smashes this narrative of that the officials and the bank has the market under control. Well, the market's not under control, because the demand for liquidity is actually, the thirst for this free money is just quite large. And obviously now we've seen this issue of the oil market. So I wouldn't be surprised if we see even more bids being oversubscribed during this week, because I think the real picture of these balance sheets are really coming into focus. And just to spend a moment on the oil market. So one of the most indebted sectors in the US economy is the oil shale sector. A lot of banks have pumped in a lot of money into the sector. Now, I was reading some analysis, and we had a chat about this off camera, that they basically, in order to cover direct costs, they need the price to be around $41 a barrel. And basically, I think in the last 24 hours, they hit about 31. And for a brief moment, it was in the high 20s. So now it's, we'll see how long these prices go for. But, banks are significantly and hedge funds are significantly exposed to the shale sector because the oil price is too low, and these energy companies have way too much debt that have been lent by hedge funds and by banks. And so if we don't see a recovery in the oil price, what we're going to see is that some of these energy companies will be on the verge of bankruptcy, and obviously if they go bankrupt, that means who's the counterparty that's going to take the hit? It's the banks. And this is why I think you're going to see an even greater escalation of free money being pumped into these banks, because the end game is to stop the banks from going bust. Because again, just like I've said on numerous occasions over the last few years, once you have a big fish saying we're done, that's the moment in which the financial markets collapse. And that's what obviously happened in September of 2008 with Lehman Brothers. And obviously there's concern about whether it's Deutsche Bank or JP Morgan or some of these other ones. And you look at the share price of Deutsche Bank in the last 24 hours, it's taken a nosedive.
Yeah, and just on the oil, some of those shale drilling oil companies, their share prices have dropped 15% and more, but some have gone down 73%. So there's been a massive shift in terms of the price. But the other point is there's quite a complex set of derivatives in this as well, right?
Yep. And
derivatives create significantly higher liability because of the multiplier effects. And so if you get significant volatility and a movement in prices, that is then when you start getting into significant issues. So my hypothesis is some of this volatility and some of this very high leverage into the derivative sector is also part of the story here.
Absolutely. Now, one of the other important things to note, Martin, is that once a week we get a set of numbers from the US Federal Reserve about its balance sheet. Now, we were told for years that with quantitative easing, it was easy to be reversed. So we had basically, we were around 800 billion around the time of the financial crisis. The balance sheet, a couple of years ago went up to about $4.5 trillion from 800 billion. They took it all the way down to about 3.8 billion. And basically, since this repo operation crisis has started, they have increased the balance sheet. And what we saw last week was, for the first time since this crisis started, the balance sheet has gone back up to 4.2 trillion. So I think we will rapidly get to the 4.5 trillion back, and then we'll go beyond. And so I think for a long time, a number of institutions and market players, bought the narrative of the Fed to say that this was all temporary, we can reverse this, and the fact that they now can't reverse it, and the balance sheet is expanding, and it's probably going to go even larger than where it was under the Obama administration. I think that's going to shatter confidence in the ability to manage the financial system and to manage the value of the US dollar.
Yeah, and just looking more broadly, John, the fact is we've got a number of central banks around the world who last week said they would actually step in and provide liquidity, etc., etc. So we should expect to see similar balance sheet expansion in other markets as well, Japan, the Eurozone, maybe even in the UK. This is really just more of the same old, isn't it?
Yes, and we also saw today with the Reserve Bank of Australia. I mean, they said that the liquidity taps are open if there is any stresses in the short-term money markets. It's interesting. The Australian press, they like to use euphemisms. Liquidity taps. Well, what is that? It's basically creating money out of nothing and just giving it to banks so that they don't go bankrupt. I mean that's effectively what we're talking about. Now, it's obviously fair to say that the Australian situation is nowhere comparable to the American situation. So we haven't reached that point yet where we're printing vast sums of money to save our banks. But it doesn't take much for our banks to get into a more prickly situation than what they currently are in.
No, and of course we are connected internationally. So as the international capital markets get themselves clogged up again, that's going to have a direct impact on the banks here locally too.
Yeah. Now, so probably 2 points I want to finish the show off, Martin, is, so one is just with some viewer feedback. So there were a few people who had an issue with our last show, and they basically said that we were sort of being quite sensationalist. Now, a couple of points to make on this is, first one is, we stand by what we said in that show. Yep. We were not, and actually, when you look at this globally, I mean, there are other people who have said something very similar to what we have said, so we're not going on a ledge internationally, but we may have been one of the first in Australia to have sort of made this sort of declaration, and to make the direct linkage to say that if New York had blown up, well, that would have frozen the international credit market. Our banks would not have been able to turn over these short-term gross foreign debt loans, and that could have led to a banking crisis in Australia. I mean, no one's sort of made that jump. But we obviously made it. Now, I just want to put a few questions up on the screen for the audience to contemplate. And so basically, what the audience has to, they ask themselves. So with these questions on the screen. So, for example, because it's now up to 641 billion. So where would the repo market be without the 641 billion? Where would the interest rates be? Noting that on the 17th of September, it went from 2.4% to 10% before they threw $53 billion on that particular day. If interest rates were higher, and potentially substantially higher than what they are today and what they were on the 17th of September, would commercial banks and hedge funds would have been able to absorb those high interest rates given the amount of enormous debt they have, and also in terms of derivatives, which you mentioned. Could they have handled those derivative bets with these high interest rates? And obviously, we say that no. Now, if we say the banks could not have handled that level, or the hedge funds, and obviously this is backed up by the Bank for International Settlements in their blog post of the 8th of December, saying that the hedge funds would not have been able to handle interest rates at that level. Now, if someone disputes the Bank for International Settlements or what we say, I invite anyone to email me and submit their argument to me. But then obviously, if a large hedge fund or multiple hedge funds, as what the BIS said, or banks did declare bankruptcy because they couldn't handle these high interest rates, the question then becomes is, could this have been contained, or would it have actually spread throughout the financial system? And obviously, because of how interconnected banks are, because of money flows, because of derivative bets, etc., it's very hard to imagine a situation where a big hedge fund, for example, or a big bank that has a lot of customers, that have a lot of trades with a lot of other counterparties, how that would not spread throughout the financial system. And then obviously, if a hedge fund did declare bankruptcy, could the financial system absorb that, or could it not absorb that? Now, for example, so this is one analyst. I remember listening to a podcast about this time last year, and they were talking about Lehman Brothers and the fact that they were talking about Lehman Brothers and Deutsche Bank, and they're saying that Deutsche Bank has a derivative books about $40 trillion. Now, this person said that given that Lehman Brothers almost brought down the entire financial system in 2008, the view was at that point that if Deutsche Bank declared bankruptcy, this was 12 months ago, this would be Lehman Brothers times 1,000. So now, is that empirically proven, that number? No, but this is just one analyst's opinion who's been in the markets for 40 years, quite experienced. But yeah, so whether it's a hedge fund or whether it's a big bank, the size of these institutions are, but in some cases much larger than Lehman Brothers, and it's hard to imagine that if one of these big fish did declare bankruptcy, that the system itself could have actually handled that without the system actually imploding.
And there's 2 points to make there. Of course, Deutsche Bank has stripped off quite a lot of its liabilities since then, right? But it's still looking a little bit sort of shaky at the moment with the share price. But the other point there is that the way that this is playing out, there's a big debate going on at the moment as to whether, in fact, we are seeing the same precursors now as before the global financial crisis, right? And there are quite a few analysts who are really, really rabidly saying, no, this is completely different from where we were then, right? But the more you look at it, John, and the more you think about what's going on, I think the more you can mirror very closely that period before the global financial crisis, where we started to get these stock movements and we started to get these liquidity issues coming in, and we had central banks trying to do things, right?
Yes.
And if they are as successful as they were a decade plus ago, then we know where we're headed.
True. I mean, so there are some differences, obviously. I mean, Greenspan was raising interest rates going into 2006, 2007, where we've been cutting rates. And obviously, there is more debt, but the interest servicing costs are lower. So there are some differences, but there are some patterns as well. So for those that are skeptical of what we said 3 weeks ago, and we did put in a lot of thought in before we said it, I would invite people to look at these questions we put on the screen and ask themselves, could the global financial system handle all these sort of scenarios and questions that we just posed? My view is that it would not have, and again, without this 641 billion, Australia would be in the biggest depression in 200 years, because the debt bubble has never been as big in terms of what it is now. Now, just to wrap up the show, so a couple of weeks ago, after we did our show 3 weeks ago, a federal member of parliament who watched the show in the government called me up. Usually he says hello. On that occasion, he did not say hello. He said to me, "What do you mean, John, that economic Armageddon has already started?" And we had a discussion about this issue, about the repo market. Now, it is actually a very technical part of the financial system, and I would say that 99% of parliamentarians would have no idea about the repo market and how it actually plays and how it connects with the rest of the financial system. And so, but this MP was basically saying to me, why hasn't my government, so again, this is someone within the government on the backbench, why hasn't my government said anything about this? Why hasn't Treasury said anything about this? Why hasn't the Reserve Bank said anything about this? Now, all I could say to this MP, I said, I don't have a lot of confidence in your Prime Minister and Treasurer in terms of their level of economic sophistication. Why hasn't Treasury or the RBA said something? Well, I honestly don't know if they actually know. What we do know, and this was revealed recently by Ian Macfarlane, the former governor of the RBA. He said publicly he couldn't see it. Now, he stepped down in 2006, but obviously there was already signs ahead of time. But I know, having spoken to former advisors who worked for Peter Costello, they had no idea. Because they lost power at the end of 2007. So going into all through 2007, I mean, there was no awareness in the Howard government that this repo crisis was actually underway with subprime, that the system was running short on liquidity. They were relying on international briefings from US officials, from the IMF, the World Bank, the BIS. Nothing was coming out of these institutions that were ringing alarm bells. And so I would say that if parliamentarians are saying does Treasury and the RBA know what we know and what we're saying, I think the likely bet is they probably don't know.
No. And in a way, because it's complicated and because it's over there in the US, they can look the other way. But because of the interconnected financial system that we are part of, it's really important that people here in Australia understand what's going on over there.
Indeed. Now, one of the other questions that this MP asked me was to say that he said, if Armageddon has started, as you say, how do I see it? Because it says, the sky hasn't fallen in. So I said, so at that point, on that day, on that morning, actually, the gold price, expressed in Australian dollars for the first time had risen above 2,500. Now, as of yesterday, for the first time in Australian history, the gold price went above 2,600. And so what I said to this MP, I said, well, the Australian dollar expressed in gold is actually sending a signal. So with all this money printing, all this liquidity that central banks around the world are throwing, whether it's our Reserve Bank or the US Federal Reserve or the Europeans, etc., it's actually having an impact on people's attitudes towards gold, around their views around the views around the risk in the financial system and the value of currencies. So I actually said to him, because this was when Parliament was in session, I said, well, how about you go into the chamber in the House of Reps and go up to Frydenberg and ask him point blank, why is gold at $2,500 an ounce in Australian dollars? And I said, I bet you Frydenberg couldn't give you a comprehensive answer, but the answer is that, so yes, there is an issue around confidence and concern in the financial markets, and there is a flight to so-called safety, but there is this issue of and this is something I tried to say on the debate against Christopher Joy when Peter Switzer was moderating, quantitative easing, money printing, repo operations, liquidity operations. All of this does come at a cost, and the cost is the value of the currency. And there are economic and social implications from this. And what we're hearing, other than really the show, is that the mainstream media, all the bank economists, people who make money from the debt market, including Switzer, including Joy, they have commercial interests where they make their living from the debt market. All of them are saying print, and obviously just save this debt market. And no one is telling the Australian public that there is a consequence to all of this activity and the activity. So if anyone wants to say, well, where's this Armageddon? How do I see it? Look at what's happening with the dollar. That's where the market is signalling to the Australian people, if you can see it or if you can't see it, that there is a problem with the currency and how central banks around the world are basically printing confetti to oblivion.
Yeah, and John, I think it's also true to say this week, in particular, with the movements on the stock markets and everything else, right? Again, the cracks are more visible, right?
Yes,
high
absolutely.
volatility, stock markets going way down, way up. Everybody concerned about the financial system once again. So it's not just a coincidence, right, that it's happening at this time. All of those issues that have been stored up for years and years and years have been triggered by the virus and everything else. But it's back to those fundamental questions that you keep raising about too much debt, right? The fact that it's not an affordable way of dealing with the issues, and all the consequences of all that debt are just not being taken into account.
Absolutely.
John, we'll keep pushing the barrow. It's really important, and I think never been more important.
Absolutely.
Thanks for your time today.
Thank you.
Martin North, John Adams, in the Interest of the People. We'll see you next time.